Leigh, welcome to the show.
Thanks, Leon. Great to be on.
Do you want to just kick off by talking a little bit about your early days as an entrepreneur?
Going back a little bit, and I'll show my age here, but I started working at McKinsey Company out of university, and then that was first dot-com boom. So we're talking back to late 90s, 98, 99, 2000. Really first wave internet, building a software as a service business. So that's how we sort of got going. But before that, I grew up in a small business in country Victoria. It was a car business. And from a family point of view, my first job was pumping petrol at the service station for a couple of bucks an hour.
How was that as an introduction to business? What do you think that taught you?
Well, first, I think it's gave me an appreciation that you can build a business. Clearly my family had done that. It was probably a third generation business at that point. But I think also just it was something that we talked about business a bit. Yeah, it was good. I think I always had a view that I studied engineering, but that I'd end up in business, and then going to McKinsey was a really good way of getting a really strong start in that. But I think, I always had a view that engineering was a path to actually building a business. So it was this sense that a career in business or heading towards that was something that would be good to do.
So when you were a teenager, that sort of stuff, was business always going to be where you were going?
I think so. I mean, while I did engineering, when I went to university, I expected I'd do engineering commerce. So that was what I wanted to do. I ended up enjoying maths so much in my first year that I ended up doing a science degree alongside my engineering. And actually, it was good to have done maths because that was probably the one thing I took with me into business, and just being able to work that through. But I think it was always a plan, but not until I went to McKinsey that I really saw the opportunity to build a technology business and seeing what the internet was doing to businesses back in sort of the first wave of the internet. And obviously that hasn't stopped. There's been waves and ups and plateaus, and grown fast and then softened and then grown again. But it's just seeing how the impact that technology was having on business back in the early 2000s or late 90s, early 2000s, and that hasn't stopped. We've seen various ways, whether it was firstly cloud computing, what I saw, and then mobile computing. So that was a big thing at Aconex, being able to take data out of the site, construction projects. And then more recently with AI, there's these waves that come through, and if you can ride them and be on the right side of them, you can be on the wrong side of them, of course, and be disrupted. But if you can take these big waves coming through in technology, there's a huge amount of opportunity.
That journey, you start the business, Aconex, in 2000?
2000 we started, yeah. We launched the product 2001.
And that's early stages, but then ultimately to an exit into 2017, 18 for about 1.6 billion, right?
Yep, that's it.
Was that what you foresaw when you started, or is that beyond your expectations? Or
first business plan, I think, we were naive, so we were young. I was 26 when we started the business, so I think we thought we'd be the next Microsoft. When reality sunk in, and we thought, no, that's just ridiculous. So I'd say our second business plan then had a lot more realism in it, and I think we wouldn't have expected to have got to the size we did. I also think we always thought we'd be an international business, but I don't think we would have foreseen how international we'd be, and that we end up with 50 offices around the world. While we're based in Australia, started in Australia, most of our revenue was, well over half of our revenue was offshore, probably 70% by the time we sold to Oracle. So we had to build an international business. So it was way more international than I think we ever expected. And also the customers we were serving, we ended up serving the likes of Petrol, the Army Corps of Engineers. I mean, these are global, the leading global engineering and construction firms that we were able to serve. So that was probably beyond our expectations as well.
When you say beyond your expectations, that was post second business plan, right? Because in your first business plan...
Oh, yeah, we thought we'd be huge, yeah. And then reality is like hard, and it takes a long time to get there. And then our second business plan was very modest. We'd build out in Australia and then maybe do a few markets. Then we were able to accelerate and grow much beyond that.
What's the time difference between business plan 1 and business plan 2 in terms of starting, the world is your oyster, and then obviously reality kicks in, and then you're sort of more realistic, but then you obviously grow beyond what you thought then. But what was the time frame between business plans 1 and 2?
I think it's probably 2 years from a capital point of view, but I think we realised pretty quickly after raising the first round. So just again, to context, so we raised just under $2 million, which was probably a lot for back then in 2000. And then, well, it's just at the end of the first tech crash, or the 2000 tech crash, maybe others before. And then, so money was hard. So we raised that money, and then to raise the second round was really tough. So I think we pretty quickly realized as we were building, off the first round, that we may not raise another cent. So I think that's a reality set in. While we raised on the 2 years, the reality set in probably 6 months after that first raise. It was like, we have to make this money last. The original business plan of hire a lot of people, get going, build a business, that was all tempered. So we pretty quickly dialed back what we're doing and recut it so that we could get through effectively.
Did you raise that first lot of money before the dot-com crash?
Yeah, well, around the same time, but
Yeah, okay.
what happened, it was probably a month or two afterwards, but the NASDAQ kept sliding, so it sort of crashed, and then probably took another 18 months before it completely bottomed out. So there was this sense that it hadn't quite died, but then so nuclear winter set in, and there was tough to raise money in tech. And then Australia, there was no, the other thing, context back 20 years ago in Australia, there were no VCs here. It was raising from family offices or high net worth individuals. And so that tech bubble deflated. It's hard to get people to then take a punt on technology. So we found quite a few points along the way that we were lucky when we raised money, but we raised money just before the GFC. That was another tough period. We raised 2008. Just got it done. GFC hits 2 or 3 years of a tough environment for raising money. And then things, of course, got a lot better in the last 10 years. From an investment point of view, I invest quite a lot in tech, but also from the companies we're investing in, just the opportunities to raise capital in Australia has changed dramatically from what it was 20 years ago. So really different environment, but we're fortunate in being able to navigate those downturns and had enough capital through each of them to get through.
And in terms of the capital raising side of things, what was the process when you started the business? Obviously decided early to raise money. Did you have any experience in that before you did it, or did any of the guys in the business, or was that all new?
Yeah, I think every time we raised, we hadn't done it before. So we're learning at each point. I mean, the very first time we literally just had to cold call people and go and see people. And having been at McKinsey, I was fortunate enough that we had a network of sorts that I was able to speak to them. So quite a few of the McKinsey directors invested in our first round we spoke to. But then we did a lot of cold calling, I guess, in some sense, sales work where we might get a contact to somebody, or in some cases we just called up a few construction companies. We heard people were doing things or might have been interested in better technology for their construction site, so we'd call people up. But it was hard. It was a lot of literally just getting on the phone to people and saying, this is what we're doing, would you be interested in investing? Obviously had a pitch of what we're doing. But we learned as we went, and then we never used anybody to help us in that. We effectively led it all ourselves, and then learn, and we got better at it over time, of course. So, and then when we did around 2008, which is a $60 million round out of the US, 60 million Aussie. Again, that was largely myself and Rob, the other co-founder. Went over to Silicon Valley, went up and down Sand Hill Road and got introductions to companies, however we could find them, to investors, and then went and pitched them on what we were doing. So it was not an easy process, but we I guess we were able to do it, and we learned that along the way.
Even that, I mean, going back to 2008, 60 million for an Aussie tech firm, back then that's huge. I mean, it might happen more regularly these days, but back then that was not commonplace, right?
That's right. And the reason we had to go to the US is there was nobody in Australia, really many growth equity investors, but certainly the venture capital side of the market's vastly different to what it was back in 2008. And I mean, there were PE investors, private equity investors, but they tended to invest across sectors, and it would have been, again, very, very difficult to get a 60 million at all check in Australia.
So take us through the process of the exit. I'm really interested to know, so you've raised the money along the way, you've got the business at a certain point. What was the thought process around the exit?
Well, talk about sort of 3 exits in a sense. So firstly, we had a secondary, a partial exit. So when we raised money in 2008, we did take a little bit of money off the table, a small amount relative to our shareholding, but enough to put a deposit on a house, and 8 years of work and not getting paid very well during that period of building the early stages of the business. So took a little bit of money off the table there. And one of the companies I set up post Aconex was as an investor second quarter, and we're doing the same thing for other technology founders and their investors and staff in Australia. So we've got a secondary fund that does secondaries in tech. So we just took a little bit off the table there. We then, same thing, the IPO, took a bit off the table there. And that was, the IPO was in a sense an exit in that some investors sold out at that point. They had the option then when we were listing to be able to exit or stay in, and we of course got new investors as well. So an IPO as an exit as well. And then the full exit, if you like, was when we sold to Oracle. And I mean, honestly, I've said this, we weren't looking to sell the business. I was very happy running the company. We'd done well, but we'd had a pretty wild ride, the ASX. We listed at our probably $400 million valuation, just under $2 a share. Share price got up as high as $9 almost. Then we got short, and a whole lot of things happened. So sort of this bit of a roller coaster. And then Oracle acquired us for $1.6 billion. But we were trading, we were about $1 billion at the time. So they basically put an offer, and we said no multiple times. We had a couple of other companies look at the business, and again, we weren't looking to sell, but eventually when we had an offer and the premium was 60% premium to our trading price at the time, was pretty hard to say no. So we sold the business. But that was really, again, personally, I didn't want to sell, but it was the right thing to do for our shareholders, given the offer that we had for the company.
They have those sort of multiple liquidity events along the way. When you look at other entrepreneurs or people in business who are building a business, how important is it that first liquidity event to be able to take some money off the table, to provide some wealth to continue that journey? Is that something you would recommend for people where they have that opportunity to take that?
Two reasons. I mean, firstly, from a family point of view, good to take a little bit. And it wasn't that we wouldn't need to work again. It wasn't life-changing wealth. It was enough to at least put a deposit on a house and something. But I think more importantly for the business, it allowed us to actually swing for the fences a bit more. So when you've got 100% of your wealth in a business, you can get into protection mode and you're seeing everything through the lens, I don't want to blow this up because I've got nothing.
It's everything. Yeah.
Yeah, it's everything. And so taking some chips off the table and put it that way it allowed us to take more risk in the business. And actually quite a few of our shareholders recommended it to us. Just said, look, when we did it with the Francisco Partners one or two of our early investors, quite significant investors said, look, as part of this, why don't you consider taking something? And their view is to do that, but they felt it would be better for their shareholding that we weren't 100% exposed to the business from a wealth point of view. So look, it wasn't like we took 50% off. We took, I don't know, 5% off or 10% off, but it was certainly sub 10%. So it was a small portion of our shareholding, but enough for us to de-risk personally to allow us to take risk with the business.
Yeah, okay. I like that concept. It makes a lot of sense. And it just gives you that breathing room, like you say, to be able to take either swing for the fences in a different way, because you do have a little bit more security in your personal wealth. So you can see the psychological impact that has.
You do dumb things as well. And I've made a lot of mistakes over the years. But one thing we did do, which is a bit stupid, not that long after that, we did another round. And for some reason, one of the banks in Australia was happy to lend us some money. So Rob and I literally borrowed money against our stock to invest back in the company. On one hand, we de-risked in quite a bit. So it was good. That wasn't probably the smartest thing to do, but that was, again, pre-GFC, I think we did that, and people were, banks were bizarrely happy to lend to some, so we'd sort of leverage up to the business, and part of taking some money off the table actually at that point was to clear the debt as well. So it was, that was probably a pretty silly thing to do, and then we sort of cleared that up as part of that round. So
you said that you didn't want to sell at the time when Oracle bought the business, but what was the emotional aspect of that like, as well as the rational aspect?
Well, personally, it was quite emotional in the sense that for me, I'd spent 18 years of my life building this business. So to have it no longer there, and I've talked about this in the past with people and publicly, I tried to make sure the business wasn't me. And so a lot of founders can get so attached to their business that it defines who they are and defines their identity and everything. And I think we were able at least to separate that, but nonetheless, still spent all this time on this business, all the people there, a huge part of my life. So that was tough. Going to be a company like Oracle, I mean, while that was a pretty big deal for Australian tech, it was a small part of Oracle. So we've gone from being 1,000 people, reasonable sized company. We've got control over that. We set the culture and everything. We've gone into a company that was well over 100,000 people in Oracle, I think, at the time. So like 1% of the staff, the business. That changes. I think culturally it was the hardest, but the other thing is I'm effectively out of a job as well. So while I stayed with Oracle and helped them integrate, it was clear that they didn't need another CEO of that. So, we're going into a division that has a CEO or an MD of that division. So, I was understanding the fact that my job was going, but then it's like, well, what do I do next? So, so there's a whole lot of things that go on, but I tried to separate that when we made the decision as a board to say, well, my responsibility. So what I want at this point is what's the best thing for shareholders. And look, financially for shareholders was the right thing to do. Financially for me, of course, wasn't a bad thing, but it just changes what you're doing day to day. A year later, Oracle accommodating me spending a year in Paris, that was good. We had an office there, so I worked out of that office as I helped with the integration, and then came back and started thinking about what next. And that's when I started building our investment businesses and doing some other things at that point.
Well, I'm interested in the what next part in that whole transition phase. Every time I talk to a founder who's exited, I'm fascinated by the journey that they go through exiting, and everyone's is unique, but there's a lot of similarities in aspects of it too, because like you're talking about, you go through, whether it's 10, 20, 30 years, building up a business from scratch and then moving on from it, difficult process in itself. And then there's that next part of what do you do next? Can you take us through some of that side of things in terms of how you processed it and what sort of conclusions you came to along the way?
Yeah, and with the benefit of hindsight, so I'm now a few years on, two things I do differently. Well, the first one is really try and understand what I want to do, or what I like doing is probably a better way to put it. And I did some work on that, and I'll come back to sort of what that means now. But then the second thing was not moving too quickly to do too many things. So I think what I did was I had a lot of people approaching me about board roles. I took on a few different board roles, and some have been great, some have been less so good. We set up, from an investment point of view, our family office and what we invest in. So there's a bit of work to do there. But what I realized was I like most of all is building businesses. And when you're in the middle of doing something, you don't always know what you like about what you do. You have a view of it, but when you're not doing it anymore, you realize, well, actually, I don't actually really enjoy that. So you can have some bad days and you have some great days, but sometimes you go, gee, this is hard work and I'm not enjoying it right now. But overall, that the personal growth and the fun, if I put it that way, the enjoyment of building a business was something I probably underestimated when I was doing it. So once I wasn't doing it anymore, I was like, wow, I actually really enjoyed that process of bringing teams together, setting a strategy for a business and growing it. And it took a few years to find the right thing, but I started another business about 12, 100 months ago, sort of building that up. That's a startup. So we're right back here. We're 30 odd people in that business back in the early days of Aconex, but I'm really enjoying that. I also enjoyed investing, but investing in businesses where I can help them. Investing in, BHP or whatever, well, that's great. You've got to do some investment, but that doesn't excite me. Some people that really like that. They enjoy picking stocks. They enjoy thinking through those sort of things. But for me, it's much more around if I invest in a business directly, I want to be able to get involved and help out a bit. That was sort of the other thing. But certainly this operating, I didn't realize just how much of an operator I was and how much I like operating businesses and building them. So that was sort of learning. And maybe I could have got there faster. But so now I've got I've focused on building Firmable, which is a new business. We're building up second quarter, which is a secondary fund. We've got our own direct investments. So Samuel Ventures does its own direct investments as a VC effectively. And then frankly, most of our investment beside that, we outsource because that's not what I want to do. So frankly, there's people who can do it better than me. So we work with managers on that side, but it's also where you want to spend your time. So some people, spending time with family was important. That's all good. But I found that I'm pretty quickly back to a pretty busy week because that's kind of what I like doing. I'm not going to sit in front of the telly or play the odd round of golf, but I'm not playing it every day. But so you sort of start to work out what you want to do in life and what you enjoy doing. And work, for some people, work is a means to an end. For me, work, assuming the work is right and it's what I enjoy doing, then that's an end in itself. I actually enjoy doing that.
Yeah, it's interesting to say that, where in terms of there's aspects, and like you say, you've obviously identified you love being the operator, looking at the strategic side of things, the more passive side of the investment side, you can pass off to other people. They can do that and you get to spend the time where you want to spend it. And there's a big benefit in identifying those things, and the earlier the better, right? In terms of what you're good at and what you enjoy. More importantly, what you enjoy, because you become good at what you enjoy, I think, more so than anything else. Yeah. And in terms of how you built the business and your leadership style, what were the biggest strengths that you had at the start and how did they change as you went along?
Well, I can tell you a strength I didn't have at the start, and that was probably coming from McKinsey. I, to some degree, micromanaged all those stuff. So I had to learn how to manage people properly. And what happens at McKinsey is a very interesting environment, and you manage it solely. You've got an intense project where you're running something for, I don't know, a couple of months, say, maybe longer, 3-4 months, but you go in and you run an intense process. But you can't run a business like that. But that's a project. You can run fast on that, and you can push people hard. But so I was probably pushing people too hard, micromanaging. Had to learn how to balance that all out. Learn how to build teams. Learn a lot around. Also, when people aren't working, I think in the early days, you start to get pattern recognition. If something's not working, you can fix it faster, or if you hire the wrong person, you can move them on if you have to. But in hiring, got better at that. So a lot of things I'd say, by the time we sold to Oracle, I think was good at building teams, good at hiring, good at attracting people and retaining people. But I wouldn't say I was good at that first year or two. Like it took a while to get used to that. One thing, like coming out of McKinsey, writing a deck and a pitch and a strategy and all that was, and I always have enjoyed doing that. So I was probably pretty good at that and have maintained that. And maybe relative to what I was at the time, it's probably not quite as strong as it was compared to other things I do now. But being able to think through a business strategically, what are we trying to do? Why does it make sense just go after a particular market? How do we compete into that market? How do we differentiate? How do we think about building into it? All those sort of questions that I think I did at McKinsey, you do it to a much higher degree when you're building your own business. It's probably one of the reasons I ended up starting this, actually. At McKinsey, we were giving advice to companies and sometimes they'd listen, sometimes they wouldn't. When you're running your own business, you can if you think something has to be done, you can do it. Being able to drive something and make it happen is certainly attractive, when you're building your own business. Yeah, it can be exhilarating at times. It can be hard at other times, but this sense of having control of your destiny is really, really important.
When you said there were things that you weren't so great at, and that obviously springs to mind quite quickly, what were the sort of the moments where you realized that and that you had to change? Because some people might not change, right? Some people might have those weaknesses. They might micromanage. We all know people who continue to micromanage and they don't grow. You've obviously identified things that you weren't doing so great and realized, I've got to change something, I've got to grow, or I've got to do something differently. What were those sort of moments? Can you remember anything along those sorts of lines where you identify weaknesses that you had to improve?
I think it's listening to the feedback that it sometimes isn't said. Yeah, and maybe something like micromanaging, somebody might say something, but people are probably not going to say that to you. I mean, they might. Most people won't be explicit with their boss around.
100%. Yeah.
So I think it's being able to listen to what's being said between the lines or not being said. And again, it doesn't mean I get it. Loads of times, I would have completely missed that. Getting feedback, just don't quite land on it. But I think being explicit with teams around you, giving or encouraging people that I was working with to give me direct feedback. We set up pretty explicit feedback processes at Aconex, so review processes, which wasn't just about managers reviewing the people reporting to them, but the manager getting feedback from their reports as well. And so it's 360s. But I think also just encouraging the conversation. Whenever I go through somebody's review, I'd always say, I want you to come with feedback for me as well. You're listening for those moments. And then there'll be stuff you just get completely wrong. Like in the early days, probably didn't, if we hired incorrectly, and that will happen, in not moving somebody on, often you'd hear after somebody leaves, well, why'd it take so long? And you're sort of realizing that while I might not have moved on something because I wanted to treat that person respectfully, or maybe didn't have the guts to do it or whatever, if that person's not working with the team, the rest of the team's paying the price. So it was after those events ago, I was probably a bit slow on dealing with that. So I think it's trying to create transparency in the business as much as possible. With Rob and myself and other managers at Aconex, we had generally a pretty open door policy. Just come and talk to us whenever you want. I think in the Australian culture, if you encourage it, people are generally pretty good at giving feedback and don't mind feeding up some things. So I think there's ways to do it. We found probably as you went international where you realize you've got different cultures, we perhaps had to be more explicit in certain cultures to encourage feedback to come up. Yeah, I think having an open mind and keeping your ears open to what's being said and trying to unpick that as well.
In terms of the sort of the best decisions that you made along the way, what are some of the things that stand out as things you got particularly right, let's say?
Well, going international relatively early, I think was good for us. We sort of always thought about ourselves as a global business that happened to be built in Australia. I think some companies go global very early and almost global day one. We weren't quite that, but we always had a view that we would be a global business and that we would, in a sense, had to go market by market, but that was really good for us. So we got to scale quite quickly. We raised money well. So I think a lot of businesses, or some go to the other extreme in raising too much capital, but some businesses don't raise enough. And I think getting the sweet spot in raising enough or more than enough, but not too much capital at each point of the journey. So we were able to raise capital and raise more than we thought we needed. So we always raised a bit. If we thought we needed 2 million, we'd raise 2.5. We thought we needed 10, we'd raise 12 to 15. So the other thing we had was also a view of getting back to break even at any point. So we talked about sort of porpoising, sort of the terminology we'd use a bit internally. What we had to use was whatever cash we have in the bank today needs to be able to get us back to break even. So we need to be sustainable with what we've got. And so we always had a back pocket plan B, which if we for some reason didn't hit our targets, we knew what levers we could pull to bring the business back into a sustainable position. And the reality was we weren't profitable. We were cash neutral for a long period, but we were never making money because we were reinvesting it back into the growth of the business. Up until 2008, we always, even though we were raising money, we always had the ability to get back to break even. And then post 2008, after the GFC, we sort of realized it's going to be hard to raise money. So we brought the business back into a cash neutral position and ran on a cash neutral basis until we listed in 2014. So this ability to really control our destiny by being able to get back to break even for whichever point we're at. And you see some companies, they've raised so much money and their burn is high, but if they miss, they're not getting back to break even. And so we've invested in some of those companies, but they're rolling the dice on the future if they don't have a plan to get back to break even.
In terms of the lessons you've learned along the way and what you did with the first business and the lessons you took away from that, how will you bring those lessons across to what you're doing today in the new business?
Well, I think, the tools are available to now phenomenal compared with what AWS wasn't even around. So we literally took our servers, put them into racks. A cloud business, it was all internet based, but we ran our own service. So we were our own private cloud, if you like. And then as AWS came along and other services, Azure, et cetera, we moved our services across, our software across onto those products. But yeah, so these days, like the ability, to plug in, as we build Firmable, we've probably plugged in 25, maybe 30 different SaaS products, everything from Stripe for billing to Clark fees, and anything we don't have to build, we won't. So if it's not core to how we differentiate ourselves in the market, it's not core to our software, the platform or generic tools will plug in as much as we can. So that's something that we couldn't do at Aconex. We would have done it if we could have, but we couldn't really do that.
It just wasn't available, right? Because different times.
I mean, we clearly, we didn't build our database, for example. So we plugged in what we could, but we had to build a lot more of the stack than what we have had to do now. We're also raising more money. So this is the other thing, like the ability to raise and go faster. So those first couple of, there was a slow growth for Aconex for the first 5-6 years. We just couldn't raise a few $1 million. I think put in context, we've raised more for Firmable in its first round, if you like, or round and 2 rounds, than Aconex did in its first 4. So we were just, the ability to scale up and go faster is something that we're doing with Firmable. I think the things that haven't changed, our focus on culture and building a great team, on clearly defining what we're doing for our customers, so being really clear on our product, how we differentiate, all those sorts of things. Different industry, different product, but getting all of that thinking done in terms of how we go to market, what our strategy is. We're trying to do that, building a great culture, trying to do that. So some things haven't changed. Some things are done in different ways, but the approach is similar. But then other things you can go a lot faster now.
What about, Leigh, you talk about sort of how much more money you've raised now compared to what you did in the past, that sort of, how much do you put that down to the whole tech and VC ecosystem is different versus an element of it must be your network and who you know and where you've been and what you've come from, right? In terms of what you've achieved. What if you had to sort of split that out, how do you sort of look at that?
Well, clearly the latter helps. Being able, having built a business, you're more likely to be able to raise money, I think. So, but it's maybe half and half. You need people to be able to write a check. And what's great now is we've got across, I guess, the big 3, and there's a bunch of other funds, but between Blackbird, Airtrue, SquarePeg, we've invested in all those funds and have supported them as limited partners in LP. And there's a bunch of others too that we're invested in. So it's not just those 3. There's probably 20, 30 great VCs in Australia now. But those 3 I mentioned, they've got billions of dollars. They've raised collectively, I don't know, 10 to 15 billion, maybe more. And they're all deploying their latest fund, which if you add that all up, is probably $1 to $2 billion worth of dry powder in the market. So the ability for those investors to write bigger checks, I think is something that's very different from when we were raising for Aconex. So it's a combination, but I think you've got to have the funds there, and then the experience obviously helps a lot where people are prepared to invest in us. Should say though, it doesn't take away the need to have a good idea of how you're going to get to market. All the things that make a business successful, whether you're a first or a second time founder, are still there. And I mean, as a second time founder, you'll be careful you don't just raise money because you can. I spent a lot post Aconex. We looked at a number of ideas, dozens, and some stuff you rule out straight away, and then we just thought there's a great opportunity in what we're doing with Firmable that wasn't being served in the market. So that was something that was worth putting not just dollars into and raising money into it, but also my time, frankly. Like if I'm going to give up a lot of my time, or that to be business has a great look, we funded it ourselves to start with, but bringing in Airtree invested in the business, we arguably could have funded it through our networks without bringing in a VC or ourselves, but having the discipline of having an investor on our board, and even just simple things like how we report and how we think about our strategy, just a discipline of having another investor in the business will make us far more successful.
Yeah, no, I totally get that. And like you say, even the accountability of bringing in that more formal process and accountability, that becomes part of that process. It's not a lot of downside to having that in place. The obvious parts about being a second time founder are sort of there. There's lots of things that you've been there before. You've got probably better networks. You've seen lots of different things. Are there any disadvantages of being a second time founder going into it? Are there any ways where you look at it and you've caught yourself thinking, oh, hang on, maybe I'm getting ahead of myself here, or there? I don't know. Are there any?
Well, if it's too easy to raise money, that can be a bad thing as well. So raise too much money. But the other one is just commitment to the cause, in the sense that As the first time, while with Aconex, it was, while we did take some secondaries off along the way and sort of de-risked, it was still, everything, all my energy is getting poured into that one business, all my professional energy. With Firmable, risk is it doesn't get 100% of our energy. So we're aware of that. I think I prioritize it ahead of everything else, but I've got a few other things that I'm doing, but it's what I enjoy most. So it sort of naturally tends to pick up most of my time as well. But yeah, you just got to be careful that it's still getting the attention and focus, and from a personal point of view, that I'm doing everything I can to make sure it succeeds. So, and partly that's also why bringing other investors is good, because losing my money, losing somebody else's money is far worse. So having the discipline of other investors then means that I'm not taking that for granted and focusing on it. So being aware of it, I think you still want it to be your life's mission, but it's probably a little bit, the risk and reward profile is probably a little bit different from the first time, so just be aware of that and managing for it.
I think there's probably some good sports analogies there in terms of teams winning the title in whatever sport it is for the first time, and the hunger that naturally goes with that. And then the teams that sustain greatness are the ones that are able to, they've achieved it, so that the hunger might be a bit different, but they still work out how to have that desire to achieve the main objective still. And I gather there's probably a little bit of that goes with it.
Yeah, that's right. So some footy teams will win the grand final, and that they fall away the next year because they've sort of got there. And the great teams they'll get 2, 3, 4 in a row. They might miss one, they come back. So I think you're right. So how you're able to learn from the first time and take the benefits of that, minimize the downside. Maybe the hunger's not quite as strong as the first time. So, but also there's pros and cons. But I think I'd say so far with Firmable, the pattern recognition, the benefit of having done it previously is far outweighed anything else. So.
Yeah, no, it's just an interesting psychological aspect to it, I guess. What are the things that drive you in terms of what you're doing next, and in terms of your goals and what you want to do with this business and in life, I guess? What are the things that drive you?
Yeah, I think, with this business, building another great Australian technology company, and I think the privilege of being able to put a team together and work with a team it's a wonderful thing. So being able to keep doing that, it's great. I think, personally, it's making sure we chair Launch Vic, which is a Victorian government startup agency, but personally making sure that we build a great tech sector in Australia. So I think, in a sense, it's not about the wealth it creates, although that's important across the economy, but more so that we're creating jobs for our kids. I hate to see Australia where it's not keeping up with technology and it misses the opportunity to build some great companies. And that doesn't mean we'll build the next OpenAI. There's certain technology we might not be able to build, but we've built a lot around that and built a lot of great companies. And I think that is great for the economy. It's great for our kids. It's great for society. So I think that's really my focus, is making sure we have a second and a third and a fourth way over time. If we can build that into the system and create an ecosystem that's much stronger than any one company, from investors to founders to the people that work in those companies, if we can build that ecosystem out, that's great for Australia.
Do you have a bucket list, or are there anything along those lines of things that you have achieved that were always lifetime goals, or on your list to achieve that you haven't done yet?
Look, love to have another successful company. So not that I have a bucket list that has to be 2 or 3 or 4 companies, but I think this sense of being able to create the great things we had at Aconex again, not just have that as a period in time that stopped, but rather that's something that acts as a platform to do more. I think that's one way of thinking about it. You clearly have a lot of personal goals, and some of them are inconsequential, like getting a golf handicap down, or spending something really important, like spending time with a family. I think getting the settings right. So I'd like to see the straight. I think it's not a personal goal so much. It's just making sure, talk about building the ecosystem, but getting our policy settings right. We seem to we don't make it easy for business sometimes. And I think we forget as a society that, usually the recent example with Coles and Woolies getting smashed for making a profit. Well, profit's not a bad thing. Profit actually enables companies to employ people and grow. And if Australian companies aren't able to become more profitable, and if we aren't able to build more successful tech businesses, then we don't grow. And I think this sense that growth's a really good thing. It creates more opportunities for people. Changing the narrative around how we think about business, I think, is really important. I think,
we demonize profit. We demonize some of these things, which are actually the engine room of profitable economy and a building and growing economy. And you do need to have those attributes. You look at the banking system here. We have a good, strong banking system, and everyone complains about the banks. I get that. But you wouldn't want to be on the other side of it, where you had a weak banking system where any sort of issue can cause some sort of banking collapse or something like that. So the strength in the institutions and some of the corporate side of things actually matters.
Yeah, I think changing the narrative around risk as well. So profit is really the reward for taking risk. And people won't take risk to build a business if there's no profit there for them to do it. And in some ways, senses, we might look at outsized profits and people that become fabulously wealthy through the creation of their business, become billionaires, whatever. But that's also the driver. And often for these people, it isn't about wealth. And maybe in cases, and that's fine if it is for people. But I think in most cases, it's not that. It's about building businesses. But that profit, that wealth that they generate is then able to be plowed back into the system. And most entrepreneurs don't. Some might go and buy a yacht. Okay, whatever. That's not me, but some will do that. But also nearly every entrepreneur I know, even if they go and buy the yacht, they're putting money back into the system.
Someone's got to build the yacht, right?
Yeah, that's right. And somebody's got to build the next wave of business, and they're investing back into those next wave of businesses. So through what we've done with Sanya, we've invested in probably 60 odd companies. Some of those will be hopefully the next wave of successes. We've had a couple of good exits, like PayApps as a recent one. We'll take the exit of our proceeds from that, and we're reinvesting it back in. So I think you build this virtuous cycle if you can get the market able to take and reward risk, and getting entrepreneurs that have been successful to go back into the system. I think that's really important. So if I say one thing I'd love to see is that Australia recognises that people that take risk and build business, there's a flow and effect, a common good that's been created in doing that. And I think we don't talk about that enough.
No, I agree with that. That narrative does have to change. What about business people that sort of inspire you along the way? Are there any people that sort of stand out that do great things that you sort of really admire?
Well, I think in the early days of Aconex, having other founders that invested and helped us. If I use one example, Craig Winkler was a great supporter, acted as a mentor, during the development of Aconex. Adam Lewis used to run McKinsey in Australia. He joined our board, became chair. Yep. But people like that have helped me to develop as a person and grow. But also in my people like Craig, and one of the things when we sold Aconex, other than what we did with investors, we also set up a foundation and we give to various charities and support that. So I think Craig is a great example of somebody who's been very successful in business and is giving a lot back through his philanthropy. And I think that's really important. And it's a great example. And he's humble about that, and probably doesn't even like that I'm calling it out. But there's people like that are successful in business, then give back through investing in your business. I mentioned before that general just investing but also taking money off the table and charitably giving it away. And so we were encouraged through people like Craig and others that we knew that when they'd had an exit, they then set up a foundation and then they're giving through that. So we've done that and we run that. We're focusing on obesity at the moment. So one of the key things we're working on there is building a product actually. So the charity supporting the building of that not-for-profit that's helping people with obesity. So things like that. And we support other causes as well, but that's probably our primary focus is on obesity, and helping people with obesity. And there's things that we can do there through businesses that we've built that help us then into that sector. So so Craig's a great example of that. Adam was a great supporter, but also the other thing I'd say is that people have helped us from the investment point of view have been very inspirational too. They might have made money in other areas, but they supported us and put their hard-earned cash into a business like Aconex or more recently Firmable.
What was the best advice we were ever given along the way, Leigh?
Lots of different things, but I think learning how to sell. And I'd probably caution, product-led growth is amazing if you get your product to do all your heavy lifting for you. But I think sometimes in certain businesses, we can think if we build a great product, we don't have to sell it. And I think that's always bad advice. I think any founder should know how to sell. So I had that, when we're just starting Aconex, like, well, you're going to have to sell it and you're going to have to learn how to sell. And it was picking up sales books, learning how to sell was good advice. This is what I'm calling it. But there's lots of other things. I mentioned the secondaries, taking some money off the table. That was good advice at the time from some of our investors. And I'd recommend that to any founder. Well, I'd still recommend those two things. Learn how to sell. Well, not all, but a lot of founders are naturally good salespeople, but not all are. And I think every founder needs to learn how to sell and market their product. And then, just de-risking a little bit along the way. So you can take greater risks. So taking some money off the table personally so you can double down on the business.
What's next for the business in the future?
Well, at the moment, after Firmable, we're scaling up the sales team. We've got the product in market. We've had product in market about 6 months. Sales are going. We've got a whole lot of new products we want to build as well. So we've essentially mapped from a data point of view. We've got data on 1.4 million Australian businesses and 10 million people. And we think we've got the highest quality data set in Australia. We'll look at doing other markets, but also rolling the quality of data we've got up into account intelligence and orchestration of sales teams. So we'd love for sales teams to be far more efficient, so that every B2B sales team out there can be far more efficient using our products and sell more and become more successful. So yeah, so lots to do on the product and the sales side and market entry for Firmable. But yeah, we're just getting started, so lots to do there.
Yeah. Well, I'm looking forward to having you on the show again in the years to come as you grow the business to the next levels.
Well, hopefully, and it's a lot to do early days, but we're having fun along the way, which is great as well.
Mate, thanks for joining us.
Thanks, Aaron. Great to speak.